All right. So we're here now to introduce Rafael from TrueFi. We are here to discuss their uncollateralized lending protocol on Ethereum. Thank you, Rafael, for joining WhalePool to talk with the trading community about your project.
Thanks for having me. It's great to be here.
Awesome. So, I mean, just so everyone can get some context, so we basically saw that Alameda did this uncollateralized loan on your protocol 4 months or so ago. That's what piqued our interest and how we sort of like recognized like, oh, this is interesting, because most lending on Ethereum, like on Aave, on Comp, on whatever, tends to be over collateralized, and people are in DeFi world, you kind of can't just trust people to properly borrow money and pay some interest rate and be credit worthy enough to pay it back. So that's why they build in this over collateralization in most of the lending that we're interacting with as traders. So tell us about like how the project got started and sort of what the team is like, what you guys are like, how big is the team that's working on it? When did you get started, and how did you get up to this point of doing the first loan?
Absolutely. So we launched TrueFi in November of last year, and the impetus for it was that we are the creators of one of the world's largest stablecoins, TrueUSD, and TrueUSD was the first stablecoin to be actually audited. When we launched TrueUSD, the only real competitor was Tether. And when we saw how stablecoins were used, a huge amount of them were used in DeFi and increasingly in DeFi lending protocols like Compound and Aave. And the way that we see DeFi overall is as building up the entire financial stack layer by layer. And we think it's going to be a multi-year, even multi-decade process. But by the end of it, that we will have taken out a significant bite of all of global finance, which could be in the hundreds of billions or trillions of dollars that will end up, we think, in decentralized finance. And what we've done with TrueFi and uncollateralized lending, we see that as one more building block that's just building on top of the types of lending protocols and the types of exchange protocols that are already out there today.
Okay, so basically this goes back to TUSD, and but TUSD isn't decentralized, right? Like you have to have custody of the dollars. There has to be some entity, some custodian that's holding the dollars, right? So is that being managed by a centralized team, but then TrueFi and this whole separate lending stuff, is that the decentralized part?
That's right. And most stablecoins today are somewhat centralized, including TrueUSD, USDC, Tether. DAI has a bit of a different model, and it is definitely growing quickly, but it still is a small fraction of the market when you compare with US dollar-backed stablecoins.
Yeah, and the other thing is that DAI multi-collateral is using a significant amount of USDC and I think even some TUSD in their collateral that they accept to issue DAI. So it's by virtue of having that multi-collateral aspect, it's actually kind of centralized as well, right?
Exactly. That's right.
So, yeah, I mean, I agree. Like, we can't, like, if we're talking about dollar-backed stablecoins, there's no real. I mean, in the end, you need to have a window where people are depositing dollars to create the tokens or redeeming tokens to receive dollars, right? And I don't think you could do that in a really decentralized way in the end. Like, you need to have some entity behind the scenes, like a DAO can't get a bank account, right?
Exactly. Yeah. And you can have more purely decentralized stablecoins like single collateral DAI, where it's only backed by Tether. I'm sorry, by Ether, but that actually lacks a crucial feature that people want from their stablecoins, which is strong liquidity against the U.S. dollar. Single collateral DAI and today even multi-collateral DAI can slip significantly against the U.S. dollar, even though it is pegged to the value of a U.S. dollar. Whereas TrueUSD, USDC, and other stablecoins that are actually backed one for one with dollars have essentially infinite liquidity against the US dollar, because you could take the entire circulating supply of TrueUSD. If you held all of it today, you could come to us and just redeem it with our banking partners for all of the US dollars that are backing it. That's what it means to be one for one backed.
Exactly, and that's why it's so important for traders that these stablecoin options exist, and that there isn't just one single stablecoin that rules them all, because we need to have it's very, in crypto it's difficult to do banking for a lot of people. Like, even if you're a straight up shop, or you're a trader that pays all your taxes, does everything you need to do, a lot of banks, they hear crypto and they just don't want to deal with you. And so it's a lot easier for us, and also for us, to have like a 24/7 way to easily transfer dollar value, like in stable form, from exchange to exchange, from entity to entity. I mean, you do have stuff like Silvergate and Signature, which have like centralized versions of these rails, where if everyone plugs into them, they can move funds back and forth. But it's still not quite the same as having it on the blockchain in the wild. You can just move it around from address to address. It's much more convenient, and it's a huge I think it's a reason why in crypto things can get so bullish, is because you have the ability to even if banks, certain banks are closing or something, there's still these like stablecoin bank, basically, where people can easily jump into Tether. They don't have to just trust an exchange and put it on an exchange. So it's always played an important role in the growth of crypto.
That's exactly right. The joke is that you go into your bank to send a wire or cash a check, and then you come home and the first thing you do is buy more crypto, right? Because when you see what that experience is like, whether it's trying to send funds, whether it's the rate you're getting at your bank, which right now I'm earning 1 basis point a year in my Chase bank account, across the board, that service is just not nearly competitive with being able to send stable coins around the world 24/7, be able to earn 10, 20, 30, even 50% APY in DeFi products, being able to instantly trade between any currency in the world. There's just so much power once you have your money in crypto, and that is what is sucking more and more money into crypto, even though there still are a lot of inconveniences that people have to face, like downloading MetaMask, setting up a ledger, etc.
Yeah, and so you have what's the current sort of stablecoin market cap for TUSD? It's something like $300 million.
That's right. It's about 300 million, and we do have 4 other smaller stable coins: True British Pound, Canadian Dollar, Australian Dollar, and Hong Kong Dollar.
Cool, but they're not as popular as, I mean, USD is the global financial reserve currency, right? So that's the most popular by far.
Yeah, USD is the king, and I don't think that any of these products are ever going to be quite as large as USD. But we do have 21 million Australian dollars, 40 million Hong Kong dollars, 16 million British pounds, 6 million Canadian dollars. So these are significant products with real usage, and I would encourage folks to check them out. I'd say part of the power of this is not only are products like TrueFi putting a very attractive yields into everyone's pocket, directly accessible from your computer or from your phone, but through these currencies, we're putting a multi-currency account, a global multi-currency account, into everyone's pockets, such that you can now transact with anyone, anywhere in the world, using a variety of local currencies, and never have to talk to a bank, never have to worry about sending a wire.
Yeah, that's awesome. I noticed in the list of currencies you didn't mention euro. I have a hypothesis of why that's the case, but let me ask a different question, which sort of gets to the same point. What is the business model of sort of the true USD? So you've got $300 million in custody. You're issuing tokens that are not interest bearing, in the sense that you're not paying interest to them. Of course, people are using them in DeFi to get yield, but you're not actually paying interest to them. So is it simply the interest you're earning on the 300 million, which might be more than 1%, I'm guessing, and then so maybe you're making like $3 to $10 million a year just off of that? Is that the general idea, minus operating costs?
That is the right idea. Yeah, our business model for these currencies is based on the interest revenue, and being a larger depositor, we're able to be selective about which banks we work with and negotiate with them in a way that consumers aren't. So we definitely are able to get a better rate on those funds than most consumers are if they just deposit $10,000 or even $100,000. But the reason why we don't have euro is actually not because of the negative interest rate, although that is definitely a concern. The larger reason is that our regulatory team has said that due to some of the regulations in Europe, we would either not be able to have people mint and redeem true euro within Europe, or if we structured it a different way, we would not have people be able to mint and redeem true euro outside of Europe. And neither of those are quite attractive enough for us yet. So we're trying to figure out a way to do true euro at some point, but don't have a clear regulatory strategy for it yet.
Interesting. Yeah, I guess there's some areas where the regulations in Europe are stricter, and then I guess in other areas it's maybe the US that's more strict, like when it comes to trading futures or whatever. You can't really do that if you're in the US, but in Europe they're not as strict. That's what I guess people have to deal with when it comes to government and the state. Right. Okay, well, that's cool. Yeah, I had actually, I was thinking it was because of the negative interest rate aspect, but it's interesting that the regulations were playing a role. So if I want to create and redeem with true USD and get some TUSD tokens or redeem them, is there any fee associated with that? I know with Tether, there's sort of like a fee associated with it, which means that there's sort of more frictions than USDC. What's the situation with true USD?
The true USD, there is no fee except any fee that your bank might charge you for sending a wire, but we don't charge a fee on our end. We just want to make it as convenient as possible. We do have minimums, and I think the minimum for true USD, I believe it's $1,000 right now.
Well, that's a pretty small minimum. I was thinking it would be like, because it's good enough if you, I would say even if you had the minimum at like $100,000 or something, that as long as the whales can arb any price differences that are observed in the market, then the market will normally hold the price. But that's pretty egalitarian of you guys, that the limit is rather low at $1,000. So where do people go to create and redeem TUSD tokens? If they wanted to do it, how would they do it?
You go to app.trusttoken.com, and you can just go through our KYC process and then purchase and redeem any of our true currency products.
Cool. And so one last question about the TUSD, and then we'll pivot to just talking about TrueFi. I just wanted to get this context. But why do you think that USDC and even USDT have sort of had more growth and traction overall versus your product TUSD?
Yeah, that's something we've wondered about an awful lot. So, Tether was here way before us and has huge penetration in Asia. USDC launched after us and is also a fully audited stablecoin. And so we see it as a more direct competitor to true USD. And I think that the way that they gobbled up so much more of this market is they had it was started by Circle. They had a consortium model that they approached Coinbase with, and they got Coinbase to sign on and join their consortium. And then they got to leverage Coinbase's huge user base and distribution. And I think that launched them to success in a way that we never could. And we did try to partner with Coinbase early on, but we didn't have the consortium model that they had. And so I think our pitch to Coinbase was not actually attractive enough.
So, okay, yeah. Are you sort of bullish in general on the regulatory front with respect to stablecoins in the US? Do you think that that it's going to be looking good in the future?
Ooh, for stablecoins,
Yeah.
I would say I'm not sure. I need to ask my regulatory team for their latest assessment. I do think that what may be even more important than just the regulatory changes that we can expect are going to be the issuance of central bank digital currencies, which may directly compete with the sort of tokenized commercial bank money that we have with TrueUSD and with USDC. And I think it's going to take many years before we see a lot of those products live, like a tokenized US dollar issued by the US government. But I do think it will happen eventually, and it will very significantly change the landscape for these types of stablecoins.
Yeah, well, I mean, you guys could. I don't think the U.S. government would issue, and I hope this doesn't divert the conversation too much. If you'll permit me to speculate that, I don't think the U.S. government would issue a central bank digital currency that had the key property that cash and coins have, where it's a bearer asset. Where, like, I don't think you would be able to have a CBDC from the US where you can just anonymously pass it around like you can with cash and coin. I think if anything, they would sort of do like what the Chinese central bank digital currency experiments are like, where you have a sort of app with the central bank. So like maybe a Fed app, and you have to like KYC to it, and you can only send the CBDC on the centralized system to other people that have the KYC the app. I feel like if the state is going to do something like that, that's probably how they would do it. And in which case, you guys could actually hold these CBDCs behind TUSD, and then people can still move around on the blockchain there instead.
That's definitely a possibility. Yeah, I don't think that we know which way it's going to shake out.
Yeah. Okay, and so you guys are one other thing. You guys are currently, the TUSD token is only on Ethereum. Is that correct?
No, it's actually on Ethereum. It's on Binance Chain. It's on Avalanche, and it was just recently launched on Tron as well. So it's on 4 blockchains already. And I think as new blockchains come to prominence and get a lot of demand, I think we'll be launching TrueUSD on them too.
Okay, thanks. I didn't quite but most of the coin is that you guys have issued is on Ethereum, I would guess, or no?
Yes, most of it today is still on Ethereum.
And I guess in DeFi, like you guys are available on Curve, right? The protocol for swapping stable coins. And I think one of the problems with having it's great to have multiple stablecoins because it's good to have competition. But one of the problems is like, oh, I have USDC, but I actually need to get to USDT or TUSD in order to, and access some other market. And something like Curve makes it very easy to swap from one stablecoin to another. So you guys are available on Curve, right? And maybe any other sort of stablecoin swapping apps.
Yeah, we're on Curve. We're on SushiSwap and Uniswap. And we've got TrueUSD on Binance and other major centralized exchanges as well, such as FTX. So lots of ways you can get your TrueUSD. And yes, that's exactly right. People do oftentimes need to swap between stable coins, like to get access to a product like TrueFi or a Compound or to Aave. Sometimes they'll have to switch into a particular stable coin.
Yeah, a lot of us are big fans of FTX. They have a sort of USD stablecoin basket where you can deposit USDC or BUSD or PAX or TUSD, and you can pull out any of those coins as well. And TUSD is definitely part of the basket. So yeah, you mentioned TrueFi again. That's a good segue, and that's what I wanted to spend the rest of the time talking about. So I think that was a good background, a good context of how you guys who have put together TrueUSD are now doing TrueFi. And I think, so as I mentioned at the beginning, I think one of the interesting things about this, so a lot of us have been in crypto for a while, and crypto is very wild west. Like you can't trust anybody. Like you always have to verify before you trust, right? And so we're used to interacting with these protocols where, like, even if whether it's centralized or decentralized, where if you want to get a loan from them, you got to put up collateral. In fact, you have to put up 120, 130% of the value in collateral that you want to borrow, and that's what everyone's been used to. And you can still access leverage that way, right? You over collateralize, you take the loan, you put that down as collateral to get another loan, and eventually that leads to a leverage position. But but I think what the cool thing you guys have done is you're just straight up, and I might be misrepresenting, but so please correct me, but you guys are just issuing uncollateralized loans to entities, creditworthy institutions, in a decentralized manner where the protocol votes on whether or not a given application for the loan is to be approved. Is that high level an accurate description of how it works?
That's exactly right. So anyone can be a lender and put stablecoin into our lending pool, similar to, you can put money into Compound, or you can put money into Aave and start earning a attractive rate. But on the borrowing side, Compound and Aave, they get over the problem of defaults by saying you have to put up collateral. And that is not a perfect system, because we all know that you can have a flash crash where ETH could lose 50% of its value in minutes or even seconds. And I'm quite bullish on ETH and Bitcoin and on crypto in general over the long term. But there's no question that you can have huge amounts of volatility in the short term, and that even when you're holding collateral, that might not protect you, and you might not be able to liquidate that fast enough. And Aave and Compound have definitely had some close shaves where assets have been not liquidated quickly enough, and the protocols have gotten into some issues. So I do think that collateral is overall a reasonable model, but it's certainly not perfect in terms of protecting a lender. And the alternative that TrueFi is taking, which is also, we think, a valuable but of course imperfect system, is to assess creditworthiness. And so, we do the true holders take a community vote anytime a new borrower is going to be allowed onto the platform. And we're actually moving towards a full on-chain credit model that will take into account all kinds of information, including your prior history of lending with TrueFi. It could even take into account other assets that you're holding in your address, or your history of lending with other protocols like Aave or Compound. And down the road, where we see this going is actually to a full on-chain credit score, where any protocol could give our credit smart contract an Ethereum address, and that's our credit smart contract could reply saying, okay, that Ethereum address has a credit score of 620 or 700. And that's going to be based on a huge variety of both on-chain and off-chain sources. And this is where we think DeFi needs to go to really take the big bite out of traditional finance that we think it's going to take.
Yeah, and because that's a great summary. So because Ethereum is like an account-based blockchain, like, I mean, if you can pretty easily associate an Ethereum address with an institution. There's Nance and others Nansen that are doing the chain analysis type stuff, where you can very easily link behavior of top trading firms with certain Ethereum accounts. And so, I mean, I guess you would the way you would assess so this automated credit system is not currently in place, right? So basically, you just have loan IDs, where like applications that people are making, institutions are making, where it's just sort of ad hoc at the moment, right? Where you have this token TRU, which is not the same as TUSD. It's this
That's right.
TRU. So the TRU token holders are basically reviewing the application. They share information like, oh yeah, this is Alameda. Oh yeah, Sam is a Chad. He has billions of dollars. We're good to lend him money, and then they just sort of approve it that way, right? But what you're saying, what you were just describing, is the sort of ideal state where you're going to actually have a system, which would it be a fully decentralized system, or would you have like a centralized algorithm that is scraping the chain data and then making a decision about the credit worthiness? Like, how would you get so I'm wondering, like, how do you know if they're doing stuff off chain which impacts their on chain credit worthiness?
Yeah, good question. So, so just to address where we are today, our protocol is definitely a bit more ad hoc today, and it is the community. True holders are voting on chain on loan applications from these borrowers, and yeah, it is a little bit of a popularity contest right now. Of people say, hey, Alameda Research, Sam Bankman-Fried is legit. We'll approve a $10 million loan, and that is so far we've done a huge number of loans, no defaults, getting a very attractive interest rate, but we completely know that's not scalable and not where we want to be long term. And somewhat, I think the way we've stayed safe today is just being pretty exclusive in who we work with. Big names that are well trusted by the crypto community, folks that already have large amounts of capital already under management, and so that's, I think, helped to protect us. But yes, we do want to move to something that is fully decentralized, that's fully trustless, and you ask a very good question about how do we handle off-chain information, right? Because someone's history with TrueFi or with other protocols, that's all on chain. That can be accessed by smart contracts and can be verified very easily by any observer. But what about someone's trading on an exchange? What about someone's total AUM? Lots of things that are important for their credit score that it's not clear how can a smart contract possibly know those things without relying on a centralized party. So here's our plan for it, and bear with me because it's a little bit technical, but basically what we're working on is the following. Have a secure enclave, which is it's a secure part of a chip that can perform some computation, and it can even pull data directly from the exchange accounts of a trading firm like Alameda. And it pulls in that information, it does a bunch of computation on it, then it can upload to the smart contract. It can send a transaction which is showing both the result of that computation, like it might say, hey, here's the final credit score that we computed, or here's like an overall risk rating for someone's centralized exchange positions. And it can also upload a proof of computation that proves that it executed the code it was supposed to execute without it actually showing what the inputs were. So hey, okay, Alameda has this level of riskiness or this amount of total equity, total assets on their centralized exchanges, so they're very safe, they're very legit. And you can see the proof of computation showing that was computed correctly, but you can't see individual balances, individual trades, etc., which of course someone like Alameda or another trading firm would definitely want to keep private. And so that's the general model that we're pursuing is use secure enclaves to compute this information, this kind of off-chain data privately, and then upload a proof of computation to the blockchain. And that proof of computation, go ahead.
Oh, sorry, please continue.
Well, it's something that you can trust. You can examine that proof, verify that it's correct. You can trust it unless someone has hacked Intel SGX, their secure enclave technology. Unless that the enclave itself has been compromised, which would be a huge breach in Intel's technology. If that was the case, then there's no way to forge that proof of computation, and that can be checked directly by a smart contract.
Yeah, so I was gonna say that sounds a bit like this proof of reserve stuff that certain exchanges have done, where they can prove that they're holding a certain amount of coin behind their balances, and individuals can even verify that their balance is within the proofs. It was something that, like, I think Greg Maxwell described years ago. I guess that's similar in concept, but it's totally different technology that we're talking about, right?
Yes, that is very similar in concept.
Okay, yeah, but I guess it's different because you're using this enclave thing. Well, so as I understand, this works if there is so I guess you would say, okay, there's Coinbase account, there's FTX account, all this other stuff, and you can make sure that they're computing properly from these centralized exchanges. But what if, I'm just looking at your website, app.truefi.io, looking through some of the loan applications that are there, and I see Multicoin Capital. They've actually got a loan application for $1 million, and it looks like 75% have voted against it. So I'm going to pick on Multicoin Capital for a second, and let's. They're great. They're big supporters of a lot of projects that we love at this community. So I'm just using it for fun as an example. But let's say Multicoin has funded themselves with like Russian mafia money, and they owe the Russian mob $100 million. How could you even capture that sort of off-chain data in this sort of system that you have described?
Yeah, so that's difficult for sure. And, for funds that are willing to do it, we can actually have a third party audit their financials, and they should be able to see, okay, well, we need to see proof of where you got these funds. And, if it ultimately comes from Russian mafia money, you're not going to be able to show real proof that you got it somewhere legitimate. But there's no question that kind of thing is difficult, because that's off-chain data, and it may not even be stored in an electronic medium like an exchange API, where we can easily access it from something like a secure enclave. So that is one of the biggest types of data that we need to figure out.
Yeah, and I mean, a lot of these firms also have like dozens of accounts on exchanges. Like, how do you really know that they're exposing all of their sub accounts and stuff like that? It sounds, and when you say like you could get a third party audit, like that's again back to the centralized world and using centralized methodology to resolve these things, which I guess you always have to do in some way when it comes to going off chain to inform stuff on chain, so that decentralized applications can perform properly in this context. Do you think this is like an irreconcilable issue, or we just have to sort of deal with certain centralized things, or this is maybe a problem that's going to get solved decades in the future, where it's not obvious maybe to us now, or maybe you have some idea that's obvious, but it seems like using I don't know, Ernst & Young or whatever kind of auditor is not a true DeFi kind of approach, right?
Right. It's that kind of thing is going to be difficult or impossible to ever get fully decentralized. But I would say that you can think of someone's credit score as coming from a range of different sources. There's a spectrum from ones that are completely trustless, completely decentralized, they're already on chain, to things like you're describing, where you have to have an auditor attest to it. And the auditor could act as an oracle and say, hey, we've examined this person's funds, we know they come from legitimate sources, etc. But there's no question you're still relying on that centralized oracle. And so that's the spectrum of where you're going to be getting the data from. But we do think that right now, part of the reason why the situation may look a little worse than it really will be is that right now the on-chain data is actually just getting built up. And we think over time, that's going to be a larger and larger fraction of where someone's creditworthiness comes from. So just as an example, Alameda Research, I think that we all know they're a very legit shop, one of the best respected names in crypto, but they were the first firm to start using TrueFi of any firm in crypto. And so I can tell you right now that you can see on chain, and this is completely trustless. You can verify this for yourself just by examining the Ethereum blockchain. They have on chain successfully repaid 6 loans already to the TrueFi protocol, ranging from $3.5 to $10 million, all completely uncollateralized, and they have in total already successfully repaid $45 million to the TrueFi protocol. So even if you knew nothing about them and their off-chain creditworthiness, that already, the fact that they've successfully repaid $45 million of loans to this protocol is already a significant amount of information to say that this address 964D ... is very likely a creditworthy address, where if you wanted to give them $1 million or even $10 million loan, there's already strong evidence that they've repaid that amount many, many times.
Yeah, absolutely. And I think looking through the loans section, I mean, you've loaned out to the community at TrueFi has lent money out to Grapefruit Trading, Invictus Capital, Wintermute Trading, Folkwang, Nibio. These are like some of the biggest trading firms in the space. Like, these are definitely the most creditworthy, and you've got, it looks like maybe a dozen different institutions across 30 some odd loans. Does that sound about right?
That sounds about right. Yes. And so we're trying to, as quickly as possible, build this kind of trustless credit score where you could now just look at their history of borrowing on TrueFi, and you could say, just from this, I already would feel comfortable loaning $500,000, $1 million, maybe even $5 million to this firm, because they've already successfully repaid so many loans over a significant period of time. That is what we're trying to build up, and that's where we think the real magic comes. So I would say, in the short term, our goal is to build the protocol for uncollateralized lending, and I think it's really our prize to lose, because we were the first ones there, and we're still the largest. And I think that we've got a very good shot of being number one in that space. But in the long term, I think that the ultimate building block that we're going to be adding to the DeFi tower that's getting built is not just around uncollateralized lending, but it's really around credit scores, where we expect down the road the Aave smart contracts maybe even calling our smart contracts to say, hey, this address is trying to borrow. Yes, we're a protocol for over-collateralized lending, but normally, while we might require 150%, if this is Alameda's address and they've already repaid $45 million successfully uncollateralized to the TrueFi protocol, then why are we asking them for 150? Why wouldn't we give them 140 or 130, given how tremendously creditworthy they already have demonstrated themselves to be?
Yeah, that's a really cool concept, and that's I think also why obviously these trading firms that want to extend their balance sheet are eager to participate in the protocol and take loans out, successfully repay them, generate that kind of data, so that once you do have this credit score thing going, and the other lending protocols can consume this data, that it will give them more potentially preferential, whether it's a lower collateralization ratio or better interest rates or some combination of both. So like, it's obvious to me why these trading firms are eager to participate, right?
Exactly. And on that point, if you know that by borrowing through a platform like this, you are going to be increasing your credit score, and then that's going to become your passport to get better rates or better collateralization ratios across dozens of DeFi protocols. Then all of a sudden, now you wonder, wow, okay, so folks that are borrowing money, assuming you're not borrowing money from the Russian mafia, assuming you're legitimately borrowing money from legitimate lenders, and you actually are going to repay those loans, why are you doing it off chain? That's the question. Why are you doing it? Because think about it, if you're someone like Alameda, Nibio, Kbit, etc., right? A lot of these firms borrow millions, tens of millions, some even hundreds of millions of dollars, right? If you're taking out that loan from someone and you are going to repay it, then right now, by doing it off chain, you are not building up any credit history that you can actually use in DeFi. Whereas if you do exactly that same transaction on chain and you show that you're paying it back, boom, now you're building up a priceless credit history.
Yeah, I mean, if you're just doing it bilaterally, then you're building only a credit history with that counterparty that you are borrowing from, right? Which maybe everyone talks in space with each other, right? So maybe they're talking to each other and say, oh yeah, we've done tons of business with Galaxy or Alameda or whoever. They're really creditworthy. So maybe like by word of mouth, but the data, the true data of what really is going on, is only living with the counterparties bilaterally. And in the DeFi. Yeah, in DeFi, it's all out in the open, so everyone can see it, and then that becomes almost like a public good. I mean, depending on how you guys end up serving up that information, people can sort of see how creditworthy these guys are. So what about linking different accounts to each other? So Alameda doesn't just have one Ethereum address, obviously. Is the plan to sort of like have a whole mapping of all of Alameda's different accounts and then trying to capture it all together?
Yeah, good question. Right now, we don't support that. Right now, we have borrower profiles that are just on a per account basis. But absolutely, in the future, we will need to really be able to get an accurate credit score. We will be able to need to show multiple accounts together. So you'll have to be able to sign with one account. Say, imagine you have two accounts, A and B. Each address should independently sign a message saying, this address is owned by the same entity that owns that other address. And that's basically those two addresses are saying to the credit protocol that they want to merge their credit histories and be considered as a single unit. And that means that if, of course, one defaults, that will impact both addresses, but also, the assets in both addresses will add up as well.
Right. Okay. So right now I can see that there is $31.5 million worth of TUSD that is available to lend right now, which means, and it says that there's a 47% lent utilization rate, which means that right now the current loan portfolio of the protocol is something like $35 million outstanding at the moment.
That's right. And you can actually see, if you're on the pool page, app.truefi.io/pool, you can actually see there's currently 7 outstanding loans, and you can see exactly how much of the money is in each of them and exactly what APY each one is getting.
Yeah, that's what I'm looking at now. And it looks like the average APR is something like 17-18%. And I look at the Aave rates right now, and they're actually quite similar for USDC, USDT. It's actually a bit higher for TUSD, looks like it is, but it's about, for stablecoins in general right now on Aave, it's like 18%. I would have thought for an uncollateralized loan that there would be sort of a higher interest rate commanded to account for the risk. But I guess these are extremely creditworthy institutions. So is that just what's offsetting it, so that basically they're getting, like, these firms are getting the same rate that they would get if they were using Aave than if they were using TrueFi?
There's actually usually a larger gap between our uncollateralized rate and the collateralized rates that you see on Compound and Aave. There's usually a larger gap than there is today. And you can see, if you look at Aave, for USDC, even though USDC today, the borrow APR is 16.7, the 30-day average is 11.8. And same thing with Tether. The rate today is 17.2, but the 30-day average is 13.1. So I think that we're seeing, this is something that we track pretty closely. We have dashboards where we track, every single day what the rates are across Compound, Aave, our product, etc. And we do see, just based on the market right now, rates are spiking up pretty high on Compound and Aave, but that's not as sustainable, we think. Like, I don't think that's going to be the long-term average, and that certainly hasn't historically been the long-term average. Whereas a lot of our borrowers, that right now are borrowing on TrueFi, we're doing loans that are at for example, we did a couple of loans recently at 18% APY with Subspace and with Bastion, and those are locked in for 90 days. So that means that, our lending pool is going to be earning that 18% APR for 90 days. And it's very rare you'll find a 90-day period where someone's paying that kind of rate to Compound or to Aave.
So, right. I mean, and there's a lot of reasons why the rates have sort of ticked up more recently. The futures curve plays a huge role in the interest rate dynamics in the space.
Yep.
Basically, there's a nice, juicy, risk-free rate that can be made by doing the cash and carry trade, either on futures or perpetual contracts. Which
be careful not to get liquidated.
But that becomes sort of the opportunity cost, which drives then the normal peer-to-peer lending market, right? So that might be part of it. But but in general, then you're observing that there's a slightly higher interest rate for the uncollateralized loans, which makes sense because over-collateralized is a lot more creditworthy, and obviously if I am a borrower and I'm having to apply a bunch of capital to secure a loan, then it's less attractive than if I don't have to apply anything except my reputation in the case of TrueFi to get the loan. I would expect to pay a higher rate.
Exactly. Yeah. And I think that TrueFi is causing the borrow rates for TrueUSD to shoot up across all of DeFi. So like right now on Aave, you have to pay 33% APY to borrow TrueUSD, and it looks like it's the past 30-day average is actually 46. So I think that actually the TrueFi offering such a good rate is sucking TrueUSD from other protocols.
Yeah, actually, I saw that number, but I was skeptical, so I didn't want to mention it, and I thought there was something weird about it. But now I'm looking at the historical, and it's actually quite high on Aave in general. And that's because on TrueFi, the only stablecoin that you are allowing is TUSD in terms of the borrowing lending, correct?
Right now, yes, but that is the single highest priority thing that we are going to be shipping. And it actually, the code is just being finished right now and is going to be entering audit as soon as next week to support multi-asset. So the assets that we're going to be launching in May are going to be other stable coins, USDC, Tether, and DAI. And then shortly thereafter, we're going to be adding support for volatile coins as well, such as Wrap Bitcoin and Ether. And I actually think that the fact that we've only supported TrueUSD so far, I think has been part of what's limited the growth of TrueFi. And I think that when we support USDC and Tether and DAI, we could even see the size of the lending pools, double, triple, or quadruple, because those products are just so much larger. And then I think with volatile coins like Bitcoin and Ether, there's almost nowhere you can get a great rate on Bitcoin or Ether today. Like Compound offers 10 basis points on Ether and 32 basis points on Wrap Bitcoin. Aave is also not great for those kinds of assets. So, and part of that reason is because there's just, when it comes to collateralized lending, there's so much interest the other way, right? So many people want to put up Bitcoin and Ether and borrow stable coins because there's a lot of interest in levering long on those assets. Very few people are interested in putting up stablecoin and then borrowing Ether or Bitcoin. And so I think that with uncollateralized lending, when you can actually earn a decent rate on Ether and Bitcoin in a protocol like TrueFi, I think that we could potentially suck in, hundreds of millions, maybe even billions of dollars over time. And it really depends on what rate we can offer. It certainly won't be as good as the rates on US dollars. So I don't want anyone to expect that. But
No.
I do think that we can offer a lot better than what Compound and Aave are offering today.
So okay, so let's walk a bit through the user journey from from the borrowers. No, let's start with the lender's perspective. So I guess most people maybe listening to this, they have some TUSD. So you mentioned the rates like 17-18% that are being paid out to the lending pool. The utilization rate's about half. So if I were to put TUSD in the pool, am I making half of the APR, or like what rate can I expect on what I am lending out to these institutions?
So if you go to our site, like app.truefi.io/dashboard, it's like our main page. It shows you the overall rate. And right now, the all-in rate, what you'd be earning if you stick some TUSD into TrueFi, is 60%, 60 APY.
Okay, so let's reconcile the payout that's coming from the borrowers to this payout that you just mentioned. So we just established 17-18% APR paid out by Alameda and company. And now you're saying I stake TUSD, and I'm not making just half of that because utilization, but I'm making 60%, so 3 times roughly the rate that's being paid. Where is this gap coming from?
Yeah, so we get a little bit of it from any assets that aren't loaned out to our borrowers. The protocol will actually put in curve.fi, and that rate, of course, fluctuates, but right now it's 15.1% APY. So that just makes sure that that almost the full pool is being utilized at one time. It'll either be lent out, which is, of course, the main purpose of the protocol, but anything that isn't lent out, we keep that in curve.fi. And that also allows that keeping some money in curve.fi also is what allows you to be able to instantly withdraw your TrueUSD, right? Because if we lent everything out, if TrueFi lent everything out, you wouldn't be able to get instant liquidity on your TrueUSD, which we know is an important feature, especially for a lot of whales that want to put in 1 million, 5 million, even 10 million. But of course, the place where so that all in gets you to about 15% APY, just like straight, on your stablecoin. But the vast majority of the APY comes from the fact that the protocol is giving out massive amounts of true tokens, TRU tokens, to all of our early users. And so that's in order to help decentralize the protocol, put the governance of the protocol directly in the hands of the users. And so that's what bridges that gap from 15%, which is paid out in stablecoin, plus this additional, it's right now about 35% that is paid out in TRU. And if you want to lock that in, if you want to lock in your 60% APY that you're getting right now, you could just on a weekly or even daily basis, you could be selling that TRU for TrueUSD or for another stable coin. You could even compound that, put it back into the lending pool. But a lot of folks are deciding to hold on to their TRU because they think that there's a lot of potential for the protocol. Like I think, if we do launch, assuming that we are successful in launching other assets in May, we do have, I think, a decent shot of doubling, tripling the size of the protocol very quickly. But also, TRU is quite useful in itself. You can stake True on the protocol, and that right now has about a 53% APY. And so there's something like $30 million that's being staked today on the protocol in order to earn those rewards as well.
Okay, so let's rewind a bit. So so even though only half of the TUSD that is being put into the lending pool is actually being lent out on the platform, uncollateralized, the other half is being put on Curve, where there's a nice yield from that whole stablecoin swapping protocol there. And I had a question there about, you said that it's that's why it's liquid for depositors. I don't know if that's a bad word to use in this. Like, we want to avoid certain terminology, but like the people that have put TUSD in, isn't there a situation where
lenders? Let's call them lenders.
Yeah, so. Lenders. Okay, lenders. Yeah. So wasn't there a situation where the locked percentage gets so high that there simply isn't TUSD for me to take out if I want to take it out? What happens if let's say that the institution, the demand jumps and the rest of the lending pool is suddenly filled up, but then I want to take out $10 million. Where's that coming from?
Yeah, so that is an issue that every protocol of this type faces, right? So actually Compound and Aave face this issue as well, and they themselves have had some very close shaves. But like Compound, I'm looking at their DAI market right now, and for example, they are currently loaning out 81% of the 650 million DAI, or something like that. No, I think a lot more than that actually. 3.4 billion DAI that they have supplied. They're loaning at 81%. Our protocol currently targets 70% to be loaned out, and I can explain where that comes from. Right now, it's a little bit lower than that, which means it might not be earning as good of a rate as it could be, but that's it's better to be lower than to be higher, because it's if the protocol goes higher than that 70%, that's when it could risk you trying to withdraw your $10 million that you loaned to the protocol and not being able to get it out. And so basically the way that we're generally running the protocol right now is not approving any loans that would bring the utilization above 70%, so that we are always keeping at least 30% liquid. And that way, the only way that we could result in not being able to give people their loan capital back is if there was a ton of folks that are redeeming their TF-TUSD, their loan capital, pulling it out all at the same time, which is certainly possible, and that could the same thing can happen to Aave or Compound as well, but so far hasn't happened, and we do think it's a generous enough buffer that it's unlikely to happen. Does that make sense?
Looks like Swap just got disconnected.
Uh-oh. Oh no.
This is a great conversation.
Yeah, can I ask a question while he's gone then? You mentioned about managing your credit risk and how you've got these on-chain analysis. Are you considering using traditional credit scoring methods? I know there's various agencies which will provide those ratings. Are you going to do any of that?
Well, can they rate someone like Alameda?
I
think the answer is basically no. We're basically going to use, we want to put into our credit score all the data we can get. And so, there are services like Dun and Bradstreet, which provide, credit information about companies. And certainly if someone is, if we can find a lot of these borrowers on Dun and Bradstreet, we would love to incorporate that data if we feel like there's real signal in it. Our goal is to add in anything that we think has real signal about the credit worthiness of these companies. But we believe that most of the conventional credit scoring agencies are not going to be able to handle crypto companies. And so most of what we're going to be doing is going to have to be stuff that we build ourselves.
Yeah. Oh, sorry about that. I had an internet problem. I apologize for that. I'm back now.
No worries.
So just to continue the flow before, thanks, Stout, for filling the gap there. But I have a couple more things that I want to cover before we open it to everybody else. So just to continue the flow from before. So you were saying about it's important to maintain some buffer so that there is the opportunity to get liquidity, but basically you haven't solved the problem that if there are locked funds, then obviously people can't. There's going to be some potential level where someone just can't withdraw their funds. You have to wait for a repayment before, or maybe more deposits before someone, and more lending to be done before someone can pull out their funds, right?
That's exactly right. And It actually reminds me of what happens in traditional finance, where banks can get into liquidity crunches, and the way that that's usually solved is they'll get a loan from another bank or from some large investor, like a big hedge fund, and they'll ask them for a liquidity injection of $100 million or $500 million, and the equivalent of that in DeFi is only going to be possible once protocols like ours are at scale, where let's say that in the future, if we have $1 billion in our protocol, Compound and Aave and other protocols might actually have lines of credit with TrueFi where they can actually, if they need the capital, they can actually pull on a line of credit and ask for some stablecoin directly from TrueFi. And they'll probably pay a higher rate than they normally have to, but it might be worth it for them if they were experiencing a liquidity crunch and they said, hey, Compound really needs $50 million just for a couple of days until it gets some of its loans coming back. It could ask TrueFi for that. That's something that we'd like down the road, but that kind of infrastructure just doesn't exist in crypto today. And so basically right now, if you're a DeFi protocol, you've got to just handle your own liquidity crunches and try to prevent them.
Yeah. No, that's a cool vision for how this can, because there's obviously going to be tons of different DeFi protocols for borrowing and lending, right? And so there's definitely a place to allow these protocols to sort of communicate with one another and to set up these kinds of credit lines. The big difference, though, is that I guess in the traditional world, the banks, they can just create money out of thin air. We don't have the privilege to do that in DeFi, right?
Well, there is one sense in which compounds and Aave and other protocols actually do create money, which is consider the following. There right now is 3.4 billion DAI deposited into Compound, right? Do you know what the market cap of DAI is right now?
Ooh, isn't it a bit over $1 billion?
Market cap of DAI, it's 3.1 billion. There's 3.1 billion DAI in circulation, but there's 3.4 billion DAI supplied into Compound. How is that possible?
Is that something to do with their C assets or?
Well, it's related to the C assets. So basically what happens is, let's say you take 1,000 DAI, right? You deposit it into Compound. You put up some of your Ether as collateral and you borrow that DAI from Compound. So you have 1,000 DAI again, right? And the reason why people do this is because they want to liquidity farm Compound in order to earn comp. And so people borrow from Compound, and then you take that 1,000 DAI and you then lend it back to Compound and you earn even more comp. And then you can actually loop this many times. If you put up more collateral, you could borrow that DAI again, put it back into Compound, and you can loop it around a whole bunch. So that's the sense in which Compound has sort of created more DAI in circulation than there actually is DAI. Now, it's actually, as you point out, it's C DAI, right? When Compound says they have 3.4 million DAI supplied, that means that there's $3.4 million worth of C DAI circulating. It doesn't mean that Compound is actually sitting on 3.4 million DAI. That's not possible because there aren't 3.4 billion DAI. There's only 3.1 billion DAI. So a whole bunch of it has actually been looped around and is the same DAI getting borrowed from Compound and then getting supplied from Compound. So Compound is creating additional liquidity in that sense. And that's actually true for all of DeFi, where just like how someone puts, a consumer puts $100 into a bank, the bank can loan out a bunch of money. That money could end up in another bank who ends up loaning out more money and so on. And the total money supply can increase. Similarly with DeFi, people aren't creating necessarily more DAI or more USDC, but if you do add up the TVL, the total value locked of many of these DeFi protocols, you'll see it can actually exceed the total number of assets in circulation because it's sometimes the same assets that are getting borrowed from one DeFi protocol are getting re-lent in that same DeFi protocol or in another one.
Yeah, that's an interesting insight, and that's an important thing for people to understand. Also, with the not just the C assets, but Aave's version of it. What they call? Are they just A assets? I don't know what they call them. But
I think it's A assets. Yeah.
Yeah.
So it's there. I guess to put a fine point on it, I would say that in traditional finance, yes, banks can essentially increase the supply of dollars. What they create is actually dollars. And in DeFi, there's an equivalent thing, except because I think it is a better designed system. The system actually differentiates between the risk of compound assets versus Aave assets versus the original underlying assets like DAI and USDC. So you can't increase these protocols can't increase the supply of those underlying assets, but they are issuing tons of new assets that can vastly exceed the supply of those original underlying assets.
Right. Yeah. And there's one thing I would quibble a bit with about the money creation mechanism by banks. My understanding is that loans create deposits, so that when banks, this is just not kind of irrelevant to the point. We can have a different discussion about this, about how that banks endogenously create money. So when they create a loan, this is creating literally out of thin air, and then that creates the deposit and the asset side to the depositor, which is the different way of looking at this money multiplier ratio. But that's a separate philosophical kind of conversation we can have. Maybe I don't know if you read about MMT, modern monetary theory, and their description of the monetary system. It's
a little bit.
Yeah, I'll send you some stuff if you're interested. It's immaterial to all this other stuff we're talking about. So you mentioned the TRU token that gets basically dropped to people that are lending to the pool.
Yes.
And that's where something like 80% of the yield is really coming from, or maybe 75, two-thirds of the yield maybe is coming from this. The rest is coming from the curve yield and the actual yield from the borrowers that are paying their interest rate. And then you said that people, and then the other thing that was interesting to me is that the TRU token can be staked, and that also has really high yields. So where is the TRU yield coming from?
Yes, so the TRU yield comes from two places. One is from protocol fees, and that's paid out directly in stablecoin. And that's based on the protocol right now charges an origination fee. Currently, it's just 25 basis points off of every loan that goes out. And that really does add up when you're talking about $1 million and $10 million loans that the protocol is shooting out. In addition to those origination fees, it also just provides a bunch of TRU. And that's where most of that 53% that the protocol is offering right now comes from. So I think that's 100,000 TRU per day gets distributed to stakers. So that's something like $45,000 per day, $47,000 per day at current prices.
And TRU. And I was looking at the circulating supply of TRU, and this is something like 20% of the total supply. So the TRU tokens being given out to the lenders on the pool, and the TRU being given out to the TRU stakers, is where this supply, this locked part of the supply, is sort of unlocking and being distributed to the users of the platform and the stakers to decentralize the system more.
Exactly, that's right. And that's led to a huge fraction of True is now, I think it's 28.4% of all circulating TRU is now staked on the protocol. So the staking system has been really successful, exceeded a lot of our expectations.
Well, it's like hyper. Well, I would guess holding TRU is it's like a hyperinflationary asset, right? Because you're printing or you're unlocking at a rate of something like 50-60% annually versus the circulating supply. So the best way to protect against that is to stake and get more TRU. Is that a fair way to look at it?
Yes, but I would say that I think that rate while yes, it is high and people do find it pretty compelling, I think that it may still be small compared to the actual growth of the protocol, right? Like I think if the protocol does well, we'll grow a lot more than 50% in the next year. You know, I think we could grow 50% in the next 30 days if we're doing well.
And ultimately, though, this is like a marketing expense in a way when you're just sort of giving away tokens to people. Like ultimately, in the long run, the protocol can only survive based on actual fees that are being paid by the actual creation of loans from borrowers meeting with lenders, and maybe other sources of income which might come from the like credit score stuff that you guys are doing. But long run, that's where the value would come from, right? Like all this other stuff is sort of marketing expenses that help incentivize people to be part of it.
Exactly. This is marketing and decentralization. And I do think that you can launch a protocol today which does absolutely nothing. And you could just make a token, foo token, where you say, look, you know, you lock up your foo token and we're going to give you tons more foo token at 100% APY. You know, and people might go crazy for it and ape in and lock up their foo token, buy foo token, lock it up, earn more foo token. You know, and as long as everything's going up and to the right, people will be excited about it. People certainly have done that, and those things definitely can moon, and they can absolutely crash right after that. In fact, I think they pretty inevitably crash after that. But I see it as you know, you want to combine those kind of rocket boosters, which can help a protocol to grow much more quickly than it otherwise would, with solid fundamentals. So that way you hopefully get that rocket boost and powerful growth, but you know, you don't come crashing down later. You hopefully stay at, you know, 100 million, billion plus size once you achieve that. And I think that the kinds of rates we're getting from borrowers will be able to sustain like a really solid APY, even once our farming programs are long over.
Yeah, like basically, as long as there's significant enough growth, and that will feed into the TRU ecosystem. But then also, so we've been going through this sort of user journey from the lender's perspective, or the people that are listening that most likely will get involved this way. But also, if you're holding the TRU tokens, you can vote on when people are making applications. So if we think of it from the user journey from the borrower's perspective, if I'm a borrower and I want to borrow something from TrueFi, what do I do? Like, let's say that WhalePool, we want to borrow $1 million in TUSD, of course. What do we do? How do we make our application?
Yeah, so first you have to get approved by true holders to even get on the platform. And you start with a forum post, that then goes to a vote. And then once you get added to the platform, then you can submit your loan application directly on the app. And you basically just have a little form in the app, in app.truefi.io. If you're a borrower, you'll see this pop up. It's a little form. You say how much TrueUSD you want to borrow, what the APY is, what the term is. You click submit. That actually launches a contract called a loan token. So every loan has a loan token that's launched by the borrower. And then true holders will vote over the course of 3 days whether they want the pool to fund that loan. And if it's approved, then you'll be able to call a function to directly just get your TrueUSD. And you can then take that, you know, put it on exchange, trade it, whatever the borrower is doing with it.
Is the loan token an ERC20, or is it an ERC 770 or whatever it is that represents a non-fungible token?
ERC 721. No, it is an ERC20, but right now, for regulatory reasons, it is a non-tradable ERC20. And so it can be, under certain situations, you can withdraw it from the pool, but it can't just be generally traded, like, you know, traded on Uniswap, etc. We do expect to get there later this year, where those individual loan tokens can be tradable. And we see that as an important way for our protocol to truly become a platform for uncollateralized lending, where now other developers could actually incorporate these loan tokens into their protocols. So an example, all of our lending pools right now work like open-ended funds where, anyone can lend money into a lending pool, anyone can leave at any time. But you could imagine someone else might say, hey, they're going to design a protocol for closed-ended funds where, you'll say this fund is only going to raise $10 million and run for 1 year. And these are the types of loan tokens that it's going to invest in. And, some institutional investors may be very interested in that. And so that's why we're opening up the loan token system later this year in order to make it be able to support any kind of protocol. I mean, those individual loan tokens, they could be traded on DEXs, they could be used as collateral in other protocols. There's a lot of things you could do with that.
Yeah, so similar like the C and A asset approach, where like if there's a sort of receipt that allows me to get back my deposit, that's an asset in and of itself. So why let it go to waste? Like let it be applied in other contexts.
This is one layer deeper than the C and A asset because we already have the TF asset. So you put TUSD into the lending pool, you get TF TUSD, and you can absolutely, that is a freely tradable ERC20 token. You can do anything you want with it. And once we launch USDC, which is probably going to be launching in May, you're going to be able to put in USDC, get TF USDC, TrueFi USDC. But this is one layer deeper because these are the actual loan tokens. So now, instead of just putting your money into a lending pool, you could even say, actually, I just want to buy up some Alameda loan tokens. This particular loan, it's 90 days, 15% APY. The whole note is $5 million. You just want to buy up those particular tokens and not be part of a general lending pool. That will be possible, which we think enables a whole nother level of protocols to be built on top of these types of loans.
Interesting. Okay, so there's one thing that I didn't catch it when we went through the initial lenders user journey. So when I put TUSD in, I actually receive a different ERC20 token called TFTUSD. And this is, I guess, redeemable later, similar to like LP tokens that you have on Uniswap or whatever. This is redeemable to get back your TUSD plus interest. Is that the idea?
Exactly. That's right. So you can, so just like how CDAI is redeemable for DAI, and its price against DAI is always increasing ever so slightly over time, right? So similarly, the value of a TFTUSD is started out when we launched the protocol as being worth 1 TUSD, and right now it's worth 1.04 TUSD. So your TFTUSD can be redeemed at any time for TUSD, and you could redeem $1 million, $5 million, even $10 million right now with a protocol and get your TUSD out. And the TFTUSD is also what you put in the farm to earn all that extra true to bring you up to the 60% APY that you can earn today.
Okay, that makes more sense now about the mechanics underlying the lending mechanism. So the lending of TUSD gets you these TFTUSD, which you then stake to get the additional yield on top of the interest you would get on the loan itself from that. Okay. But then now, okay, so we're getting deeper into the inception of DeFi here. So now you're saying you're going one level deeper, and just like in the movie, I'm getting a bit more confused, but let's see if we can follow. So you're saying now you put in the TUSD as a lender, you receive TFTUSD, and then so the loan token was created by the borrower and satisfied by the lenders as a group. And you're saying that the loan itself gets tokenized and is an asset that can be traded. How is that possible? Because in the end, the borrower is repaying to the TFTUSD people. What's the value of this loan token in that context, given that the rights to the profits or the repayments are really going to the TFTUSD people?
Okay. So this is a common misunderstanding. So and I know DeFi is confusing, But when you put TUSD into the pool, then you get TFTUSD in exchange, and that represents your ownership of the lending pool. And when the lending pool makes a loan, it actually will send out TUSD to the borrower, and it gets the loan token in exchange. So for example, the pool right now has a loan with Subspace Capital that's outstanding right now at 18% APY. And there's this loan token, 0x8688, ... which is which was issued by Subspace Capital. And the pool is holding about a little over 1 million of this loan token. And when Subspace Capital repays their loan, they basically allow they basically allow any of the holders of this loan token to redeem the loan token for TUSD. And so they put the TUSD back into the loan token. The loan token smart contract handles that redemption process, and the vast majority of the loan token is just held by the lending pool. So the lending pool will redeem its million loan tokens for 1 million or so TrueUSD. That's the way the loan token system works. And right now, these loan tokens are primarily just used within the TrueFi system. So they represent the debt that each borrower has to the lending pool. But as we enable them to be openly traded, you're going to be able to hold some loan tokens even just in your wallet, and then you can when the borrower pays back that money, you can redeem the loan token for the TrueUSD. And this does actually happen today because the main way that people withdraw their money from TrueFi, you lend money to TrueFi. When you want to leave, the protocol will just give you TrueUSD back. But there's another option that most people generally don't opt for because it doesn't give you as much liquidity. But you can, instead of just receiving TrueUSD, you can get your share of the entire lending pool, of all of the assets in the lending pool, which includes a whole bunch of different loan tokens. And so if you choose that, then you'll end up with loan tokens that you can actually redeem once these borrowers pay back. But most people, for a very good reason, would rather just have TrueUSD so that it's liquid today, as opposed to loan tokens that are probably still completely solvent, but they're only going to be liquid in 30 days, 60 days, 90 days, etc.
Got it. So this is the difference between the lending pool assets themselves and the liability that is going to be repaid by the borrowers, but is subject to the timing at which they actually repay it.
Exactly, that's right. And so down the road, all of these loan tokens will be tradable on Uniswap, SushiSwap, etc. And the lending pools themselves will actually likely be market making on these tokens. So the lending pool, let's say it just loaned $10 million to Alameda. Well, it's happy to sell off that debt. If a bank gives someone a mortgage, then okay, now the bank is holding an asset, which is that person's debt. And the bank is happy to sell that off to a hedge fund or to another bank. And so these assets get traded around. Similarly, if the pool makes a $10 million loan to Alameda, it's happy to sell off that Alameda loan token to other purchasers that want to buy it. And it will just charge a very slight premium above what it thinks the fair value is.
Yeah, no, that's cool. That I think it totally makes sense to make them tradable. So if I'm a borrower, then I don't need to have any TRU. All I need to do is make WhalePool wants to borrow $1 million. We make a forum post. We pay some gas to do that, and let's say it gets approved because they know that WhalePool has tons of money. They're good for it. We're going to borrow. We're going to get basically through the velvet rope. So now we're approved as like a counterparty, and now we then make a specific application for a loan saying we want $1 million. We're willing to pay 15%, let's say, over the APR over the next 90 days, and then it just gets put to a vote. So so far we don't have to have any interaction with TRU tokens, right? We're just interacting with the protocol no ETH is required to pay for gas and everything. And we're connecting obviously an Ethereum account, and then we put it to the community on TrueFi to vote. So how much of the voting, like what's the quorum? Who's really deciding whether or not I get this money? We get this money.
Yeah, good question. So right now, the system, it's a little bit confusing, but basically the quorum is, I think it's half of the size of your loan. So if you're looking for a 10 million TrueUSD loan, which is that's the largest loan that the protocol currently can make, then that would require 5 million TRU to vote on that. And the percentage required to win is a function of the APR that you're paying and the term. But currently, it actually only takes a few % of TRU holders to vote against the loan in order to make it not be approved. And we launched the protocol that way just to make it very conservative. So it's very easy for TRU holders to shoot down a loan if they think it's unsafe. But we're probably going to, over time, adjust that to something that is a bit more moderate, like a 70-30 kind of ratio to be approved.
Yeah, because my first thought was, okay, how can I attack this thing? How can we, go out and buy a bunch of TRU tokens and just rig it somehow so that we can take out a fat loan and just run away with it and approve our own loan? It sounds like you've done a bit of thinking around this and are preventing it by being conservative. What about the getting in, what's the quorum? So this was for the loan part where you say, okay, you have to have at least half in TRU tokens in the same units, but it takes only a few %, you said, to shoot it down?
That's right. Yeah.
Right. And what about once to get in the door, like through this velvet rope to actually be approved as a counterparty? Is that a higher bar?
It's not really. That is done right now via a forum vote. I don't think that we currently do. We currently do snapshot votes for actual protocol changes, but for adding borrowers, I think we're still just doing forum votes. We are going to be moving both of those, both protocol changes and adding borrowers to the protocol, to actual on-chain votes, similar to how Compound does them. But for right now, it's on the forum and on Snapshot, respectively. Okay,
and all right, so then a borrower actually doesn't need to have anything to do with TRU tokens. They just, so let's say our $1 million loan gets approved. We get our, we get our $1 million, 1 million TUSD, right? That we have to call the function, receive the TUSD. Do we have to pay, how often do we have to pay the interest on a 90-day loan?
So you just have to pay the interest when you pay back the loan. That's it. So yeah, you don't have to have any TRU. The TRU holders will just vote on, getting you added to the platform and getting your loan approved, and you just get the money. You trade it, you invest it, you do your thing, and then at the end of the term, like when those 30 days are up, you repay the full amount, like principal plus interest. And if you don't, then your loan will be in default. And before any loan goes out, we do sign an actual legal agreement with every borrower to make sure that if any of these loans were to ever end up in default, we'd be able to pursue the borrower in court. So that's it's a totally normal loan agreement, similar to like if anyone who's doing like over-the-counter loans in crypto, it's very similar to that. So it's just as enforceable as any other loan that doesn't have to do with DeFi.
So do they have to KYC? Do we have to KYC to get this, or how do we? At what point are we signing this document as WhalePool getting the $1 million loan?
Yep, you do have to KYC, and we actually have you sign the document before we let you through that velvet rope into the kind of walled garden of approved borrowers. You do both KYC and sign a document. Right now, that is with our private company, with TrustToken itself, but we are setting up a foundation which is going to act as the centralized counterparty for all these loans. and that's going to serve the protocol long term, because we know that a DeFi protocol, that's made a loan to someone, it's gonna be a while before that's fully enforceable in a court of law, and so at least until that's completely established, and we're very confident that DeFi protocols, are legally enforceable, we want to make sure that there's an actual legal entity that is the counterparty for all these loans and is signing them on behalf of the protocol and can pursue someone in court if needed.
Okay, so there is that still this centralized aspect that is needed there. So like if we take out the $1 million loan, we go, let's say we go buy a bunch of Solana tokens or something, and maybe the market goes the wrong way and we don't feel like paying the loan, then you'll be able to sue us, basically, like not the decentralized protocol, but it would be TrueUSD that would be the counterparty technically.
It'd be our company, TrustToken. That's right. For right now. And very soon moving to a foundation. Yeah. So that's one other detail I wanted to highlight for people that are listening. So when you're talking about voting on the individual loan proposals, it's not TRU token that's being used, but actually STK TRU, which is a token that, and I don't know if this is correct, but I'm just reading and checking this, but I can only vote on these individual loan proposals if I have staked my TRU and received this STK TRU ERC20, then I can vote on the proposals. Exactly. And that is what makes sure that people that are voting on loans actually have skin in the game. So you have to stake your TRU, and when you stake your TRU, you get these very attractive rewards. Right now, 53% APY. But you're also taking on risk. So anytime there's a default, up to 10% of the staked TRU can be liquidated to cover that default. So right now, that would cover a pretty significant amount. Like that would cover up to $3.2 million, because there's something like $32 million staked today. So that helps protect the lending pool. And so you should only stake if you really believe in the protocol and are willing to take at least a somewhat active role in governing which borrowers are allowed onto the platform and which loans are approved. Because if you vote for a loan that ends up defaulting, then that's your TRU that's going to get liquidated to go protect the borrowers. And so you're strongly incentivized once you've staked your TRU, and there's a significant amount of TRU staked, right? Like $32 million of TRU has been staked. Once you've staked, now if someone applies for a loan who's pretty sketchy or who really shouldn't be borrowing that much, you're strongly incentivized to vote no and to shoot down that loan. Because if that loan goes through and ends up losing money, you're on the line.
And is there any cooldown period when you unstake?
There's a 14-day cooldown period, and yes, that is what helps to prevent. You can't just see like, oh, I think I'm going to get liquidated, I'm going to unstake today. Yeah. You have to go through a 14-day waiting period there. Okay,
so now we've covered then all the different tokens that sort of like pop up in this whole journey. That started with the TUSD is what's actually used in the end. TRU token is what is then provided as yield to people that are lending. TFTUSD is what is coming out when you have lent, which you use to stake to get more TRU. And then STK TRU is what you get when you have staked TRU token, and you can use that to do the voting of the loans applications. And it sounds like lenders come first, really, in this whole protocol, where you're looking out for lenders in the end, that the people who are approving the loans and stuff like that, in the end, their TRU tokens, if there is a default, because the big risk in this whole system is just that these uncollateralized borrowers are defaulting, and that could be either bad actors or it could be just be some shit has happened in the market, and people can't cover their loans. And is there some way? So if there's been a default, let's say WhalePool defaults 90 days from now.
Yep.
But then, oops, we made a mistake. Sorry, we were out partying, so we were a week late. We want to pay back the loan. Sorry, we want to make good on everything. Is there like additional penalty that's on top of the principal and interest? And also, can I prepay the loan? Let's say that we took the loan out and then a month later we're like, we just want to pay the whole thing back. Is that possible?
So right now you can, if you pay back early, you still have to pay the full amount. That's something that we could change in the future, but that's how it works today. And there's right now a very short grace period of 24 hours that we don't want borrowers to use. But if someone makes a mistake and you sleep in, forget to repay your loan, then as long as you pay it within 24 hours, TRU won't get liquidated. It won't be a strike against you, but beyond that, it will be considered to be a default if you pay 10 days late, and TRU holders will get some of their TRU liquidated to send that money over to the lenders, and you probably your credit score would probably take a significant hit. These are very legitimate firms that we're lending to, and we expect a certain level of professionalism. This is real money. So of course we and they are trying to be very careful that those kinds of mistakes aren't made. But one thing I would mention, though, on your question about the paying it a little bit late, we are actually launching a line of credit product as well. So right now, all of the protocol's loans are fixed term, fixed rate, fixed size, but we're going to be launching likely in May a flexible line of credit option. So now borrowers can choose to either take out a fixed term loan or take a line of credit, and both will count against their total credit limit. So if you have 10 million, if WhalePool is approved for $10 million, you could decide you want to take out a $5 million line of credit and then a $5 million fixed term loan, for example.
Yeah, so I mean, I guess so in the event of default, that loan token, once it's tradable, would obviously trade at some kind of discount, but you don't want to basically, I mean, I'm sure you guys have already thought of this, but I'm thinking if a borrower has been in that situation, you want to give them a way out. You want to give them some incentive to, at some point, even if it's just partially repaying, that it should be better than not paying anything at all. Like if I, as a bad borrower, am in a situation where, okay, these guys, they've put a strike on me now, I may as well pay nothing, because what's the point in even paying a little bit if we set aside all of this, like pursuing them in court and stuff like that. I think in general it's always good to give borrowers a way out and to reward them for at least doing something. And obviously I could speculate and buy the WhalePool loan token, and I think, oh, these guys, they're going to pay it back, and then I should still get that full repayment if they do repay it, right? Or is this True tokens liquidated to repay the loan token itself?
The True is likely going to be liquidated just to repay the pool. You definitely could buy the WhalePool token if you think that it's still going to be good for the money, and it might be trading at some fraction of a dollar. It might be trading at 50 cents if people think that there's like a 50% chance that WhalePool is still going to repay. But I completely agree with you that someone who does pay a loan back just 7 days late or 14 days late, it is valuable to offer them a like, hey, this won't hurt your credit score as much as if you never pay it back, and there can be a path to rebuilding that credit score as long as you do pay it back. If you really default and never pay it back, then your credit score is going to be probably more permanently damaged.
Okay, and then so I think we covered basically like the whole spectrum of the protocol, and it's like the perfect amount of detail that our community likes to hear. Like clearly you guys have thought about all the different angles. It's a really elegant and cool DeFi protocol, I would say. I mean, obviously by necessity you've had to centralize various aspects. Like you always got to put training wheels on these things initially, and then the idea and the vision is to sort of take them off, obviously. But I think it's a really cool system overall. So one thing that I know the guys that are listening and in the chat are going to want to ask, what about the Ethereum fees? And like, obviously you're on Ethereum, and it sounds like that you're building the next thing still on Ethereum. Obviously TUSD you've put on Avalanche and these other chains that you mentioned, but you didn't mention Solana. And a lot of us here are huge fans of Solana. And like, is there any, like, what is your view in general on, do you keep building on layer 1? Do you do something in layer 2? Do you think the current state of affairs with fees on Ethereum is acceptable? Do you have any ideas of going to a different layer 1 for the entire protocol, or having a multi-chain setup? What do you think of this?
Well, it's still early days for us on this question. I'm also a fan of Solana. We do a lot of work with Alameda, and they were the first borrower on our platform, and they definitely have expressed interest in having us over there, and it's something that we very seriously would consider for the future. Right now, we have so much development to do just on our core protocol that really has to be our focus. But I do think that long term, assuming that some of these other protocols such as Solana or Binance Smart Chain continue to get a lot of interest and adoption, I do think that we could very well end up being a cross-chain protocol, and having lending pools and farms on multiple different blockchains. But there's a ton of work for us to do there, and at least the next couple of months, we're gonna have to be pretty laser focused just on improving our protocol on Ethereum, taking those training wheels off.
Yeah, and also you mentioned the plans of like multi-asset, so it's not just TUSD, but all these other assets that come into play. Like that's a huge step in the growth of the protocol, it sounds like. But what about, I mean, I guess the footprint on layer 1 for the protocol isn't that big, so maybe you're not getting as much of the sort of pressure about like Uniswap, for example, or like others where there's just tons of transactions going, and it sucks to pay hundreds of dollars. I mean, I don't think anyone finds that acceptable, and that's why there's such a, in general in the Ethereum community, a push to do layer 2. But you're not feeling that pressure to at least go on a layer 2 to relieve the pressure because of this, or what do you think?
No, we very much are. Our transaction costs have gone up significantly, very similar to Compound, Aave, Uniswap. It's getting costly to use any of these DeFi protocols, and a lot of people in our community are concerned about that. So I do think that likely before we launch on a second blockchain, I think there's a good chance we would end up on Optimism or another layer 2 solution. But that's also something where we're just right now waiting and seeing how that goes for other protocols, rather than ourselves being a first mover.
Yeah, fair enough. I mean, I guess Uniswap is going to Optimism, but there's also StarkX. A lot of the exchanges like Diversify or DYDX, they're on StarkX. So there's going to be competing layer 2s, and so there's, I guess we'll see how that whole thing evolves. Are you, one more question before I guess we're going to see if there's any questions from others that have been listening, maybe if you have time. But
yeah.
Is TUSD, are you worried that by going multi-asset that TUSD is like maybe not going to be used as much, and that suddenly, like, is it more interesting for you that the protocol grows by having multiple assets than it is to sort of create a use case for TUSD?
It is far more important to us to grow the protocol to its full potential than to give TrueUSD this exclusive position. It was a great way to just get started, because we had to start with a single asset just for simplicity, get the protocol off the ground. But we think that lending a single asset, we would have almost zero shot of becoming the protocol for uncollateralized lending. And actually, because we're doing uncollateralized lending, we actually can take it a step further than other lending protocols like Compound, Aave, and Maker, which limit the types of collateral that you can put up. Compound lists, something like, I don't know, is it 11, 12 different assets on there? 12 today. TrueFi is going to, later this year, be completely open, just like with Uniswap or with SushiSwap, where you can take any ERC20 token and immediately create a lending pool with it, and then have borrowers start to borrow it out. And we we hope to see that become a rite of passage for new projects, just like how a new project would put 10K, 100K, $1 million of their token and put it on SushiSwap or Uniswap to give it initial liquidity. They could also put a bunch of their token onto TrueFi and get it in the hands of folks like Alameda Research, so that way it can have some liquidity on centralized exchanges and over the counter as well.
Yeah, no, I think that I think shows that the TrueFi protocol and the team and the project are focused on the right stuff. It's not just like a way to shill TUSD, but it's like it's much bigger than that. Obviously, when expanding to other assets, like that is a really cool vision. All right, well, I think that this has been awesome. By the way, thank you so much. Like, we've already been going at it over an hour and a half. Like, I think the fact that you've been going into all these details and been very open about it is like you're perfect WhalePool guest, that you're very open and able to talk on a technical level and also explain these things is fantastic.
My pleasure.
So is anyone that's out there listening, so only some of you have talk access, but you anything you think that I didn't cover that you want to ask Rafael? He's been very open about all of these things. We have asked about Solana, so no need to mention Solana. Anyone think that some angle has been covered that you want to ask and use this opportunity to ask?
I
want to mention Solana again, you can.
I had a question, and it may have been covered. It was around how are you pricing the loans in terms of the interest rate? You know, are you going to have a variable rate depending on the risk score that you see from the borrowers?
Yep, that's the plan. So right now, as I mentioned, it is a bit more ad hoc. Borrowers can propose an interest rate, and then as part of their loan application, and then the true stakers vote yes or no. And we do have, like Multicoin Capital and Amber Group, for example, both had some loans recently declined, not because they aren't excellent firms. They both absolutely are, but because they weren't offering an APR that was competitive with what some of the other firms were offering. And then KBIT just actually yesterday came in and offered a 16% APR that is pretty competitive with what other folks are offering, and so they're getting a very strong reception from true stakers. So right now, that's the process. But we have a first version of our credit model is expected to be shipped in May, and that's going to then it's going to be taking into account a bunch of information about the borrowers and outputting, as you said, a risk score for each one, which might say, hey, if we're primarily lending at a rate of, let's say, 16%, maybe Alameda, because of their huge AUM, etc., they can actually borrow at 16%, but WhalePool, because they've got a smaller AUM, newer borrower, less history, they're going to be at like a let's say +2 rate. So instead of borrowing at 15 like Alameda, WhalePool might have to borrow at 17% or something like that. And that reflects the fact that the protocol is taking on a little bit more risk by lending to WhalePool when it could be lending to Alameda, but also needs to get compensated with a corresponding amount of additional gain.
Great, thanks for the response.
What about our Australian community members? Viper is a huge Ethereum fan. He's not a huge user of Ethereum, but he was a early ETH supporter. Do you have any questions, Viper?
No, just to say though that was absolutely phenomenal. Thank you so much for that. I did have questions, but that was they were all well and truly covered off. So thank you very much for that, guys, both of you.
That's my
Wonderful.
goal every time. My goal is to be so thorough that these guys don't have anything basically to ask afterwards.
Yep, you got
We're
me.
very thorough.
Okay, well, we're gonna prepare our loan application and give it a shot. No, I'm just kidding.
WhalePool isn't a fund, is it?
No. We're this is just a free open trading community, so we're just having fun here. Yeah.
Right.
This isn't one of those like paid trading groups or anything like that. We're just a community that's been around for a while. We like to share as much free information as possible to everyone, and that's what you've been participating in on this effort, and I think it's been super informative. I didn't know really anything about TrueFi. I had heard that Alameda did this, and I was like, uncollateralized lending, that's crazy, that wouldn't work. Until then recently, sort of this came up, and I was I think I learned a crazy amount in just the past bit over hour and a half here discussing this stuff. So it's been really informative. We're gonna so I guess if there's no other, I don't think anyone else has any other questions. I think we covered everything. So thank you so much, Rafael, for coming on. It's been really informative. Really appreciate your time. We're gonna record this, throw it up on YouTube, and we'll share the links with your team. I think this has been a really, really informative guide for anyone that wants to learn about the protocol. Anyone listening to this, you go to app.truefi.io, so TRUEFI.io, and you can get on there and start lending TUSD right now and staking TRU and earning 60% yields right now, basically. And there's some really creditworthy borrowers on the other end. You probably aren't creditworthy enough to go borrow right now, but there are borrowers that are on the other end, and it's cool to see that you guys are making the effort. Because I mean, someone like me, when I heard uncollateralized, I was like, this is impossible. But I like that you guys are doing it anyway, even though parts of it are centralized, and some people might say, oh, that's fake DeFi or whatever. But obviously this is like all the different layers to it. You definitely made an effort to make it as decentralized as possible. So I think it's a really cool project, and anybody out there listening should check it out. So thank you very much, Rafael, for coming on. Really appreciate your time, man.
Thank you very much. It was my pleasure, and I would love to have you all get involved in it. I mean, we're just a bunch of folks trying to build something interesting, and I do think we're onto something here. But please come hang out with us. We've got a Discord. You can find all the links to our Discord, Twitter, etc., directly on TrueFi.io.
Cool. Yeah. We're mostly on TeamSpeak, not Discord. So I'm just kidding. But
we don't have a TeamSpeak, but we maybe we should get one.
Well, but just tell them to come here, because WhalePool is the place to be. So even if they could go to TrueFi for the Discord stuff, but for anything else, you can come to WhalePool on TeamSpeak. But yeah, no, that's so Discord, Twitter. Anything else that you think people should know? Just final bits of information or anything?
No, just come check out the protocol, check out the community, help us build something cool.
And then yeah, multi-asset is coming in a few months. So people that are like, oh, I don't use TUSD, I'm not interested. Well, in a few months, you guys are gonna have multi-asset. That's something to
in a few weeks. Right? It's gonna be here in May.
Weeks, okay.
Yeah.
We're gonna hold you to that.
You got it. You'll see
awesome.
it in May.
All right. Thanks, I appreciate
guys.
your time, man.
Great, thank you.
Yeah, thank you very
much.
much.
See you around.
Fantastic.
All right, cheers, mate. Awesome. Cool.